Hi, my name is Joe Novickis, and I'm going to go over some golden rules to personal finance / investing. So if you want to hear more of these videos, just hit the subscribe button at the lower left, and away we go. So this first video I'm going to kind of go over, which everyone kind of is always interested in, is investing in stocks. Investing in stocks is a great idea because it's passive income. If I buy a McDonald's stock, I don't have to wake up every day, go work at McDonald's. I get a share of the earnings because McDonald's pays a dividend. At the same time as the company continues to grow and expand, my price per share will eventually grow. However, picking stocks individually is a very challenging thing to do, which I'm going to kind of break down and share some information with you. Overall, if we look at investing, there's so many different stocks that you could pick from. So I'm going to kind of show you here a little bit about how that works. Here is the overall heat map of the S&P 500. So if we think of the S&P 500, it's an index that measures 500 publicly traded companies. So here it's broken down by sector. So there's different sectors that make up the stock market. And so some sectors will go up. Some will go down, some will go sideways. So it just kind of depends upon what the sector's doing. But instead of kind of going in and trying to pick the right stocks and what fund managers do, the best way to invest is just to buy the overall index, to buy the index that measures the S&P 500. Warren Buffett, who's one of the most successful investors of all times, he has said over and over and over again, pros won't get a better result than index funds. And he's right. Statistics that I've seen is that only around a third or a little less than a third of professional fund managers will actually beat the market in any one given year. So what that's being said is that all these people with finance and degrees and they study the market nonstop, only 1/3 of them could beat the market in a given year. And if we look at those third that actually beat it, to beat it consistently year over year, very few could actually do that. So to illustrate, if we were to take our money and put it in an index fund, if we did that back in 1980, we put $10,000 in a low-cost S&P index fund. Since January of 1980, the index has generated a return of approximately 7,670%. So this is from Motley Fool, and so they looked at that data. And so this is a company that actually tells you to pick individual stocks. They're even telling you that index funds have a good return. Okay, so what we want to make sure that we as we look at becoming investors is that we could go into the Robinhoods of the world, we could go into E-Trade and create brokerage accounts and try to pick stocks. And I'm not saying don't do that. I think it's important that as we invest in the overall index, I think it's okay to make a long-term investment in a company. There's nothing wrong with that. But I wouldn't put all your money into 1 or 2 or 3 companies. What you want to do is you want to hold all the companies for that diversification. So if you just go on Google and type in top stock index fund, here's the first thing that pops up. Vanguard Total Stock Market Index Fund, VTSMX. So I went in and I kind of, to show you that, you're going to own basically the S&P. So this return mirrors the stock price of this index fund, returns pretty closely the S&P return. And if you look, the fund ratio, the expense, is very, very low. It's 0.14%. So the way mutual fund managers make money is that they charge a fee on their fund because they're buying and selling stocks in the fund. Here, there's not a lot of buying and selling. It's doing whatever is going on with the overall index. So if the index makes a change, then they'll change it. But there's not too many changes to be had. So therefore, the expense ratio is very low in these particular types of investments. And if you look within the last 5 years, you can kind of see that almost looks exactly like the S&P chart. At the same time, you're also getting a dividend yield. So right now, you're getting a 1.92% yield on your money. So for every dollar that you have invested, if you were to buy it today, you're going to get a little less than 2 cents for every dollar. But what happens in the way you get that nice return is you take those dividends and you buy and accumulate more shares. And that's how kind of compounding interest works. So you could get out there and you could try to get in there and pick all these individual stocks and try to beat the market. But odds are you're probably not going to do it year in and year out. So why are you trying to play that game? You're busy working, you have a life. The best way to kind of go about it as a long-term investor is to buy these index funds. So that's step one. Step one is, as we look to invest, we want to be position ourselves into stocks and equities. We don't want to put 100% of our portfolio into stocks and equities, but the majority of that we do put into equities, we want to put into these index funds. And the reason is that individually, you're not going to pick 5, 6, 7 companies, and those companies more than likely are not going to beat the overall index. So there you have it. There's the first video I want to share with you. Please check back and look at more and try to come up with a strategy, but you won't want to miss the next videos in my series. I'll release some every few days, and that kind of give you some tips to manage your wealth and to manage your money. Thank you.